Hello and welcome to our first video lecture dealing with chapter 13. The idea behind these videos, and especially the flipped classroom, is that you guys are kind of getting introduced to the material before you come to class. So you guys, after watching this video, or the videos rather, reading the text, working on that study guide, you guys should have kind of like those. You guys should have those um, low level abilities as far as being able to recite certain things, knowing definitions. So the idea behind these videos are to pull out some things that are really important that you should spend some time before class going over, knowing those terms. So when we get into class time, we can really dive into the material, focus on the calculations, and really do some high level thinking about the material. So chapter 13 really deals with return, risk, and the security market line. Now, we will be doing we will be calculating returns, and we also will be calculating variance and standard deviation. So there is going to be that element of chapter 12 that's going to come into play. Um, so what are we going to talk about? Well, by the time um, Monday rolls around and we finish class, you should be able to do all of the following, right? You should be able to calculate expected returns, variance, and standard deviation, okay? When you come into class on Monday, I would expect that you know how to calculate average return, because we talked about that in class yesterday, as well as variance and standard deviation for year-to-year returns. So we're going to take those same concepts, but we're going to apply them now to individual stocks, and we're going to compare stocks. We're going to look at portfolios of stocks. You should be able to, or you should know what diversification is, right? So by the time you're done reading the chapter, watching these videos, working on your study guide, you'll know what diversification is. So when we get to class, we can talk about diversification. What does it look like? What are the benefits of it, right? Are there any drawbacks of it? You should know what the systematic risk principle is. And you should also be able to describe the security market line and the risk-return trade-off. Again, the expectation is when you guys come to class on Monday, you'll know what these definitions are, okay? All right, so first thing we're going to talk about is expected returns and variances. We'll get into portfolios. We'll talk about announcements, surprises, and expected returns, right? What happens when a company makes an announcement, right? Hey, we're going to lay off some people, right? Or we're going to launch a brand new product. What does those announcements, what do they do to the marketplace, to the financial markets? We'll talk about risk, systematic risk, unsystematic risk. We'll also talk about diversification and portfolio risk. We'll look at systematic risk, and we'll talk about beta, and we'll also look at the security market line. Now, before we dive into any of this, it's really important to recognize that this chapter 12 and this chapter 13 really emphasizes the economic foundations of. So there's a lot of economic foundations in this chapter, like there was in chapter 12. Okay, so we have certain assumptions, right? And if I were you, I'd probably write these assumptions down. First assumption deals with investor rationality, right? We assume that investors are assured, or investors are assumed to prefer more money to less money and less risk to more risk, all else being equal. Well, that makes sense, right? We think that we assume that investors are rational. They obviously want more money than less money, and they want less risk. They don't want to assume all kind of risk. Okay, The result of this assumption is that the ex ante risk return trade off will be upward sloping, and we'll talk about that a little bit as well. Um, it's also it's also important to recognize that these investors are risk adverse. They're return seekers. Okay, investors will take action that is consistent with their rationality assumptions. Okay, um, investors, again, this is the assumption that they will require higher returns to invest in riskier assets. And we talked about that last night in chapter 2, the second lesson from market history, right? The higher the risk, the greater the reward potentially, okay? Um, and again, we say that because those investors require higher returns to invest in those riskier assets, they are willing to accept a lower return for a less risky asset. Okay. Um, so, again, as we go through this chapter, keep in mind we're trying to project into the future, right? What's going to happen in the future as far as stocks and bonds and investments? We want to be able to calculate the risk that's involved in investing in a certain asset, right? Whether that's a stock or a bond, okay? So investors always try to seek to reduce risk, again, while maintaining for a desired level of return, okay? So let's look at expected returns, okay? Very easy to calculate. We'll get into the calculations in class on Monday. But right now, the expectation is that A, you know what expected returns are, and you know the equation to calculate expected returns, okay? And again, we'll go through a lot of examples to illustrate the mathematical nature of these expected returns. Okay, so what are expected returns? Well, expected returns again are based on probabilities of possible outcomes. Okay, what's the probability that we're going to make money, right? What's the probability that we're going to lose money? Okay, so when we're talking about like analyst projections or their picks for the future, they look at a lot of different things, right? They go to a specific company that they're analyzing. They talk to management. They look at the industry as a whole. They look at the economy, and they make their predictions. Okay. So basically, what we're saying is, based on these predictions, there's probability of certain outcome. Okay, we're either going to have if the economy booms, we're going to have a 30% probability that we'll make 70%. We'll have a 70% return. Okay, if by chance there's a recession, the probability of there being a recession is, let's say, 70%. Okay, and if that state of the economy happens, meaning a recession, then our return will be 5%. Okay, so basically what we're doing is we're saying what's expected. Okay, what do we expect? And when we say expect, we're talking about the average. Okay, and we'll see when we get into the math of it, which is very simple. We'll see what we mean by that average. Okay, so again, the expected return again does not even have to be a possible return. Okay, it's just a guess, right? So there are going to be times when what we expect to happen versus what really happens in the future do not equal. Okay, they're not the same thing. So how do we calculate the probability or the expected return, right? Well, the expected return is just the sum of the probability of an event happening times that return that we would get if that event happens. Okay, so think about it this way. Okay, let's say we're flipping a coin. Okay, If it's heads, then we'll say that I'll pay each of you guys $1, okay? If it's tails, all of you guys have to pay me $1 in this example, okay? So remember, and if you remember from statistics class, right, the expected value is really 0, okay? Why? Well, because there's a 50% chance that I will have to pay all of you $1, plus the 50% chance that all of you are going to have to pay me $1. Okay, so what's that mean? Well, that means that if the game's played over and over, then each of us, meaning you as the students and me as the teacher, we should all expect to break even. Okay, but if the game is only played once, then either I'm going to win and receive $1 from each of you, or you folks will win and I'll have to pay each of you $1. Okay, so again, the real takeaway here, the main thing to understand as we go into Monday is we're taking the probability times whatever the return is if that event happens. Okay. Here's a quick example. I don't want to get into too much detail because we're going to be talking about this in class, working on it in class. But if you notice, there are two stocks, C stock and T stock. Okay, and if you remember, I said it's the probability that an event will happen times that return. Okay, so let's look at C. Right, there's three options or for the state of the economy. This economy can boom, right, takes off. The economy can just continue as it is, meaning it'll just be normal, or there could be a recession. Okay, so let's assume here for a moment that, I don't know why there's question marks here. There shouldn't be. It should be a 2. Anyways, so let's look at the boom, right? There's a 3% probability that the economy over the next year or quarter, whatever, will boom, okay? And if the economy booms, stock C will have a return of 15%. Scratch that. Stock C will have an expected return of 15%, okay? But what if the economy is normal, meaning things continue to go as they are? Well, there's a 50% probability that that's going to happen, right? People that looked at the economy, or the analysts that looked at the economy, that looked at company C, that talked to management, that understands knows the products that they're offering and the plans that they have in the future. They say that, you know what, if things continue the way they are in the economy, there's a 50% probability of that happened. And if that happens, our return, if we invest in company C, will be 10%. Okay? Let's just say by chance there's a recession. Okay? There is actually a 2% or a 0.2 probability or a 20% probability of there being a recession. Okay? If there is a recession, our expected return for company C will be 2%. Okay? So what we do, and let me go back here, and again, we'll work on this heavily in class. Right now, as long as you know this equation, you're fine. Okay? We say that we want to calculate the average return for company C. Okay. Well, there's a 0.3% chance or a 30% chance that there will be a boom, and if there's a boom, we'll get a return of 15%. So we multiply the 0.3 times the 0.15 or the 15%. Well, to that, we add the probability of the economy continuing the way it is, right? There's a 50% chance of that. If that happens, we expect that we will have a return in company C of 10%. So we multiply the 0.5 times the 0.10. To that, we add the other probability of the state of the economy. Well, what if there's a recession? Well, there's a 0.2% chance of that happening. Okay. If that does happen, 2% chance or 0.2% chance of that happening, our return in company C we expect to be 2%. Okay. So we just do the math as it is. We multiply the probability by the expected return and add them to each situation, right? Boom, normal, recession. We see that we get an expected return of 9.9%. Okay, that's our expected term based on the future. Okay, now what if we said that the risk-free rate of return is 4.5%? Okay, 4.5%. Bear with me here. I want to draw. Okay. We say the risk-free, and I'm going to abbreviate RF, is 4.15%. Okay. We want to know what's the risk premium. Okay. Now, this is a review from chapter 12, right? So you should know this already. So what is the risk premium for stock C? Okay. Well, if you remember in chapter 12, we took the average return and we subtracted that risk-free rate. Okay. Well, for stock C, our average return, or in this case, our expected return, is that 9.9%. We then subtract that risk-free rate, which is 4.15%, and our risk premium then is 5.75%. Okay? And that 5.75%, again, that's our risk premium. Risk premium. Risk premium. Okay? So again, when we come to class on Monday, the only thing I really expect you to know and be able to regurgitate is this. Oh, nope, wrong one. This equation. Okay? So let's look at variance and standard deviation. Now, we already talked about variance and standard deviation on Monday. Okay? So the formulas that we're gonna look at are slightly different than the formula in chapter 12, right? Because if you remember, in chapter 12, we said that we take our, bear with me here, in chapter 12, we said that our equation was the average, right? We said that in chapter 12, we took our squared deviation, we added all of our squared deviations up, and we divided by n, which was the number of observations, minus 1. Okay, that's what we said in chapter 12, right? We said we divide by n minus 1 instead of just n. Okay, so now, since we're dealing with probabilities, right, it's important that we recognize that the probabilities are used to account for the division. Okay, so remember, the standard deviation is nothing more than the square root of the variance. Okay, so again, we come to class on Monday, you should know that right off the bat. We'll work on the numbers and plugging and chugging and doing all that other good stuff with the numbers. But for right now, the main takeaway here is recognizing that, just like from chapter 12, variance and standard deviation, right? What are we trying to measure? Well, we're measuring volatility of the returns. Well, volatility is really just another word for risk. So variance and standard deviation really measures the risk of the returns, okay? We're going to be working with unequal probabilities, okay, for the entire range of the possibilities, and we'll see what we mean um, in the next slide here. But again, we'll get into this in class. Coming away from it or coming away from the video, the only thing I really expect you to know on Monday when we meet is, hey, how do we calculate variance for expected returns, right? Well, if we're looking for variance, it's just the sum of the probability of the event happening times the return, right? Minus the expected return, okay? That's all it is. And we're going to square that puppy, right? So let's just look at a quick example just to kind of give you an idea, okay? So let's think back to the previous example that we had here, right? We had 0.15, and we're looking at C, 0.15, 0.10, 0.2, or 0.02, and we had our probabilities, okay? So how does this look? Well, for stock C, right? We're taking our probability which is our 0.3, and we're taking our expected return minus our average return, right? Our average return. And we're squaring it, okay? We're doing the same thing for what if we assume the market's going to be normal, right? Well, there was a 0.5 probability of that, right? We have to calculate the variance. This was the expected return. This is our average expected, This is our average expected return, and we're squaring that. And then we're doing the same thing for the recession, right? What's the probability times the difference between the expected return and the average return squared? Very simple, okay? So we see here that our answer is 0.002029, okay? Our standard deviation is nothing more than 0.5, okay? So what I want you to do, and we'll talk about this on class on Monday, and I just kind of want you to put some, kind of get you guys thinking about it outside of class. What exactly is variance measuring, right? What is variance, right? I know what it is, but what exactly does it mean? Okay, so we're going to talk about that in class. So if I were you, I'd maybe kind of Google variance, right? Go on Investopedia. It's a great website, by the way, great resource. And Google, what is this variance? Why do we do it? Okay. All right. So another example. We're not going to go through this. But we're going to stop there, okay? Again, the real takeaway, what you need to know for class on Monday is what is that expected return, right? What is the expected return? What's the definition of it? It's based on the probabilities of different possible outcomes, okay? You're definitely going to want to know conceptually just this equation. Okay, and then we'll talk a little bit more about it in class on Monday, and we'll start working on problems with this, okay? Kind of went through a very quick explanation of how to calculate it. Again, you'll get more practice. We'll work on this together in class. I don't expect you to be able to do this right now or when you come into class on Monday. Just know the equation, okay, and have an idea of how we do it. Same thing with how we calculate variance, right? You want to know this equation, okay? You definitely want to know that equation, and you want to keep in mind that the formula is a little different, right? In chapter 12, we divided by n minus 1 instead of just n. Okay, so keep that in mind. Risk-free, how to calculate calculate the risk premium. Should know that already. But again, if you don't, make sure you do when we come to class on Monday. And then again, expected returns. When dealing with probabilities, how to calculate that. Oh, sorry, I'm going the wrong way. And how to calculate the variance and standard deviation based on volatility of returns. Okay. When we come back in our next video, we're just going to look at portfolios very quickly, and I'll just tell you again what you need to know for Monday. So thanks for tuning in, and we'll see you in our next video.